Okay, thank you for having me in this energy cafe. My name is Bert Scholtens, and I need to disclose that my main affiliation is with the University of Groningen in the Netherlands, and I have a part-time employment for almost 15 years now with the University of St. Andrews, previously the School of Management, now the Business School. And this is not about energy and not about ethics, but it closely relates to that because I want to find out how droughts which can be associated with climate change and climate vulnerability, associate with corporate bond yields. So I'll first introduce the topic to you, then I'll briefly connect with the, for me, relevant literature and introduce and motivate the hypothesis. Then I will inform you how what type of data and methods I use before I go to the results, and then discuss some implications which hopefully result in a discussion. Okay, so the topic is drought. So this is the result of drought, so that has a big impact directly on the on land and what grows or does not grow upon it. And I connect that to what's going on in the biggest financial markets in the world, which is not, I repeat, is not the stock market, but it is actually the bond market. You have to realize that most investors have more than 50% of their wealth usually is invested in bonds. And bonds are most of the time fixed, say more or less loans for a maturity between 5 and 15 years, which pay a coupon and can be traded in international markets. And a big chunk of these bonds is being issued by sovereigns, which have big debts, and they finance these debts with issuing bonds. Okay, so this is from the World Economic Forum, which in Davos meets. All the big shots go there, and every year they produce a report where they highlight the biggest global risks. And this is an overview of the risk they report with a different nature. So economic risk, environmental risk, geopolitical risk, societal risk, and technological risks. And we see that since 2012 that also environmental risks pop up substantially, and that does not go away. So also for the future, the World Economic Forum expects that extreme weather, climate change, water supply crisis will occur. So the topic I investigate in deeper is drought, and drought is a very disastrous for economic activity because it affects the whole supply chain. It is geographically widespread and is very difficult to predict. Very difficult to predict. The most studies so far focus on water-intense industries, and they show that water-intense industries are food and paper and pulp, and they show that these industries are quite vulnerable to drought. And financial market participants increasingly want to understand the cost of climate risks and their origin and how they might address this. So this motivates the research question of our study. So does the firm exposure to drought risk influence bond yield spreads? And what bond yield spreads are, I come to that in a minute. So this topic is of interest because drought increases the cost of doing business. So that translates also in higher prices or less services being produced. So drought can bring about also intertemporal risk because they do not occur immediately, but they have a lag effect, and it can also result in structural change of the way in which firms produce. There can also be what we call a disaster risk premium, which highlights that drought is an additional risk for especially the financiers, but also other firms in the supply chain. It occurs sporadically across time and across location. So it's difficult to predict. Now, these characteristics are can be dealt with in what we call asset pricing theory, which suggests that asset that is drought could be diversified. So the idea behind diversification is that not everything occurs at the same time. So if you spread your investments, your assets widely over the globe, over different industries, then these risks imperfectly correlate and then can be diversified away. However, because of climate change, changing of both a qualitative and a quantitative nature, say flooding, storms, drought, it suggests that it is not that easily diversifiable. So we really need to investigate it in more detail. So there is quite some literature in this regard already about bonds and climate. So that connects with what in fact drives bond prices of corporations. So usually we have firm characteristics, market characteristics, say where these firms operate, country factors, climate policy and climate regulation play a role. Also the environmental profile of firms appears to play a role in the price of a bond of a firm. Now then, so that's the firm perspective. Then we have the financial market perspective. So it shows that climate risks can be well integrated in what we call asset pricing models, and that there are the models that are used to appreciate the processes on financial markets. And for managers, both investment managers and corporate managers, it's important to understand whether this drought influences investment and capital allocation. So how to allocate the investments of a firm, because there's a lot of irreversibility. So if you plan to set an office or a factory somewhere, you can't easily move it elsewhere. Now, other strand of literature relates to climate risk appreciation. So most of this literature, by far most of this literature focuses on emissions, and that is carbon dioxide emissions or carbon dioxide equivalent emissions, so where all the other greenhouse gases are also translated into carbon dioxide. And then the finance literature has quite some debate about whether you want to investigate absolute or relative emissions. So that's what we call intensity. So that's one strand of this climate risk literature. Another literature that studies climate risk is based on scenarios. There we have two, sources of these scenarios. First is the IPCC, that's well known from climate science, which produces regular reports with different scenarios that in fact have expectations about the trajectory of climate change. Next to that, and that's more important for financial institutions, is the Network for Greening the Financial System. That is an association of supervisors, financial supervisors, for example, the Bank of England, but also the Dutch Central Bank, the Federal Reserve, People's Republic Bank in China. All these type of financial supervisors, they come up with a discussion group which informs standard scenarios which financial institutions have to use to stress test their portfolio against climate changes. So these are the scenarios being used and studied in climate risk. Next to that, we have events, the impact of hurricanes, of floods, of wildfires on corporate and portfolio performance. Now, our study about drought sits in this last strand because we investigate drought, which can also be regarded as an event. So the hypothesis is motivated because the corporate bonds have a very important role as financing firms' operations. And bond investors, say the institutional investors or retail investors who own these bonds, are primarily concerned with downside risk. And that's because the That's different from stock, because if with a stock, yeah, prices go up and go down. So you have both downside and upside potential, whereas the upside potential is quite limited with bond investors, as yeah, the coupon is a fixed rate, and you have the risk of default of this counterparty. So they are especially concerned about such a default occurring. So we hypothesize that drought risk may be reflected in the pricing of corporate bonds. More specifically, we expect that firms with more exposure to droughts have to make do with higher yield spreads, as investors will demand some compensation for this uncertainty and the increased downside. We study this on a sample of US firms over a 20-year period, and we compare the yield of their bonds in relation to what's called a swap curve. Yes, maybe you've heard of the yield curve, and the yield curve is based on the treasury yield, say the government debt. The swap curve is based on not on the treasuries, but on the corporate bonds. And we have information for more than 500 firms for 2,500 bond issues. So on average, about one firm issues five bonds. So these are the descriptive statistics. The mean amount issued with such a bond issue is $330 million US dollar. They pay a coupon of almost 5%. The maturity of such a bond is on average 15 years, and the yield spread compared to the swap curve is 230 basis points, so 2.3% above the swap curve. Now for drought risk, we rely on the so-called Palmer Drought Severity Index. In this Palmer Drought Severity Index, they use temperature, rainfall, moisture, and that is based on measuring stations in the United States. And it is a range from -10 to +10 with lower, that is more negative values indicating more severe drought. Now this is an example of the weekly value of this index from October 24. So this shows for the US there is it's relatively dry, especially in the west of the US, and it's moist or wet in the eastern part of the United States. Now we we look into this how bond yields relate to the index as such, and also to severe and extreme drought, and to a drought trend. And this drought trend is the change in droughts across different states in order to capture the long-term effect of climate change. Yeah, so that's what we investigated. For severe and extreme drought, we look into the Palmer index being smaller than 3. So that is the dark orange and the light orange areas here. Okay, so we have the index, and we have then the most severe drought areas, and we have this drought trend, and the drought trend is calculated across the different US states, and we use an autoregressive model for the index that is augmented with a time trend, this T in this model. So we have coefficients for the intercepts, for the time trend, and for the autoregressive index term to differ across the states. And the states is depicted by this small I, the suffix. So this trend term is our parameter of interest in relation to the drought trend, because it captures different time trends in droughts along different states for the long-term effect of climate change. So basically, this is how our model looks like. So we try to explain these yield spreads or swap spreads in relation to the drought risk, where we have 3 different proxies: the index, the severe drought areas, and this trend, we account for firm properties, for properties of the bonds, and we have year fixed effects and firm fixed effect to pick up additional volatility. So let's go to the results. So how do the yield spread relate to this Palmer drought severity index? So we find that there's no significant association between the yield spread and this index. So it does not show that in different firms in different states have which have a higher or lower score, that there is a clear relationship with the yield spread. The leverage and returns on assets, they play a dominant role in determining this yield spread. Then we go to the severe drought, say that is where the Palmer index is smaller than -3. Again, we find no significant association between severe drought and the yield spread of the bonds. Then we go to this drought trend, so that is mentioned to capture change over time. Here we find a clear, a highly significant positive association between the yield spread and this trend. And again, also leverage and return on assets play a significant role next to size and asset turnover. So that means from an economic point of view, if the bond belongs to the smallest decile in a specific year, the yield spread of such a company is expected to increase by 50% in the next year, which translates into about 44 basis points, which is really economically substantial. So this is a very pronounced result, I would say. We also look into geographical dispersion, because a firm's headquarters may not necessarily be the same location as where the business operations are. So to capture this, we use tax data, and we construct a dummy variable, which is one for if the foreign income tax paid is higher than the domestic income tax being paid by this corporation. And then it shows that the relationship between drought and the cost of debt is especially present for firms with a domestic focus. So drought risk is more likely to affect firms through the exposure of their customer base rather than the location of the headquarters. We also look into the industry relevance because previous research especially focused on water-intense industries. And in this regard, we differentiate between what we call sensitive and not sensitive industries, where the former are agricultural, food, healthcare, communications, and transportation. And here we cannot establish that there is a difference in the impact of drought via the three proxies between sensitive and non-sensitive industries. So this we cannot confirm previous research in this regard. We also look into the role of regulation and awareness. So you will all probably know that in November 2015 there was the Paris Agreement, and that might have increased the awareness of all agents, investors, firms regarding climate risk, and that this suggests more exploratively that there might be a stronger effect after Paris Agreement. Therefore, we split the sample and rerun the regressions for the two subperiods. And then it shows that the drought risk is significantly related after the Paris Agreement. And there is no evidence of such an association before the adaptation. So it shows, so this finding suggests that the relationship was clearly stronger after closing the Paris Agreement. And we are especially interested in the mitigating factors, as already showed up in the earlier results, especially return on assets and leverage. So the motivation that we do so is that drought might be relevant for the credit risk of firms, and then firms might want to reduce their leverage, say how sensitive they are to debt financing, and might want to increase profitability to gain a buffer to get more solvent against the potential impact of drought on their business, because drought might eat into their own funds. And indeed, we find that the effect of drought risk on the yield spread is weaker for high profitable firms. And so they are less sensitive, as shown by the yield spread. So to wrap up our results, we find that there is a significant and a positive relationship between companies in the US yield spread and the drought trend, not the Palmer index or most severe. So this specific type of drought risk increases the financing costs of these companies. It also shows that the impact of this drought risk especially is the case for firms that operate domestically. We find that it seems to be the case that it is widespread, so homogeneous across different industries. And we also find the effect is especially pronounced after the adoption of the Paris Agreement. So these findings have several implications. So firms might want to consider drought risk if they want to locate or relocate within the US. It is also that drought risk increases the cost of debt financing. We find that it matters for all industries, not just for the water intense. So therefore, all these industries need to prepare and employ mitigation strategies in relation to drought. And we think that the disclosure of, say, the sensitivity to drought risk is highly relevant for investors, given the significance of our findings, and also to regulators who can have, next to the say the scenarios and next to looking into firms' carbon emissions intensity or the amount of their carbon intensities, we have an additional metric to come to grips with climate change at a firm level. We are concerned that climate change might accelerate by the US withdrawal from Paris Agreement, and given that the US is already a highly carbon intense society, so that drought risk might further increase and bring additional cost to society and to business. So that is my presentation, and I'm open to take questions and suggestions for further research. Thank you.